This is video lecture T7C on cost recovery. It's long, so let's not dilly-dally. You're going to be performing some calculations in this video, so I suggest you keep your calculator handy. You may also want to have your book around and open to Chapter 7 so you can access the depreciation tables as needed. This video is about the cost recovery of tangible property, which is almost always depreciation. A couple of definitions before we get too far along. Real property is not property that is not imaginary. Real property is real estate. Tangible property that is not real is personal property. However, do not confuse personal property with personal use property. For example, my house is real property, but it's also personal use property. My car is personal property, and because I don't use it in a business, it's also personal use property. We recover the cost of tangible property using depreciation, which has been through a few changes, but has settled in on MACRS, Modified Accelerated Cost Recovery System, for some time now. Like other income and expenses, depreciation has a recognition rule in tax. It begins when the property is placed into service, and this is not always the same as the date of purchase. For example, the construction of a building may take years. Depreciation will begin when the building, or perhaps part of the building, is ready for its intended use. So here is the IRS method of calculating depreciation. But here is the shortcut method. What is the right table? Depreciation tables are prepared by the IRS for taxpayer use. In this class, we're going to use a set of 7 or so, which can be broken down into a set for personal property and a set for real property. There are other tables, however. Depreciation for tax purposes is a prescribed system. There are not many choices, and thus you are instructed to simply use the tables. Of course, software can handle many of the computations, but we're going to practice the old-fashioned way. In order to pick the right table, we need to identify the applicable convention. But we need to understand exactly what a convention is. Let's look at this set of hypothetical property acquisitions. You can see the property was placed in service at different times during the year. I have been nice enough to count the number of days each property was in service. For example, the furniture will be in service for 351 days during the year. The truck, 286 days, etc. One might expect that as a result, the typical depreciation calculation must take into consideration the number of days when computing depreciation, which, by the way, generally uses double declining balance for most personal property. So we just pull that old chestnut together and off we go, right? Yeah. The convention is available to make life easier for taxpayers. For example, the general rule for personal property is that you treat all the property as if placed in service at exactly the 1/2 point during the year. Not only does this reduce the complexity of the calculation, but it permits the creation of a table that all taxpayers can use and never need to count days. However, taxpayers are smart, and a crafty one might decide to place everything in service in the last part of the year, because that way a 1/2 year of depreciation is available for everything placed in service even on the last day of the tax year. As a result, the tax rules invoke a mid-quarter convention for taxpayers that place more than 40% of their personal property into service in the final quarter of the year. Under the mid-quarter convention, the taxpayer treats the property as placed in service halfway through the quarter placed in service. Thus, step 1 is to apply the convention test to see if the half year or mid-quarter convention applies. That convention applies to all personal property placed in service that year, and each year is tested separately. As I mentioned, to avoid taxpayers preparing computations, the IRS provides tables. Here is an example of a half-year convention table for 5- and 7-year property. Okay, enough talk. Let's just do an example. We're going to start together, and then I'll let you work on your own a bit also. Let's go ahead and read the case. Okay, so we need to depreciate the assets, and we're going to go ahead and assume that that final piece of equipment was placed in service in the last month of the year. So we need to identify the table, and in order to do so, we need to apply the convention test. We start by determining when the property was placed in service during the year, and then measuring the amount that was placed in service in the fourth quarter. Since that percent is greater than 40%, the mid-quarter convention applies. Now we just need to find the right tables. Let's start with the copier. It was placed in service in the first quarter, so we need to use the mid-quarter convention for the first quarter. The recovery period is 5 years, so we find 5 years in the column. And since this is the first year, because we placed it in the service this year, we find year 1, and voila. The depreciation factor is 35, or 35%. We take the cost basis of $1,500, multiply that by 35%, and depreciation in year 1 on the copier is $525. Now let's do the same for the computer. It was placed in service in May. That's the second quarter. So we need the second quarter table for the mid-quarter convention. It is also 5-year property, and so for the first year, the factor is 25%. Times the cost of $3,000 is $750 in depreciation. Okay, now you should be able to finish the other assets placed in service this year. I'm going to pause the video while you work on it. Well, you're going to pause the video. Okay, here is the solution. You should be able to match the depreciation factors with the third and fourth quarter tables for the assets we didn't do together. So total depreciation is about $4,200. How'd you do? Hopefully you did okay, but we're going to practice some more. Okay, practice makes perfect, so let's presume that the new equipment is not purchased during 2017. If we rerun the convention test, we're going to see that less than 40% of the personal property was placed in service in the fourth quarter, and so the half-year convention will apply. If we recalculate depreciation for the copier and computer, we can see that using the half-year table allows us to apply a reduced number of factors as compared to the mid-quarter convention, since all the properties of the same recovery period will use the same factor. Thus, the copier and the computer both use 20% for 5-year property in the first year. You should be able to finish the remaining depreciation yourself. Go ahead and pause the video and work on it. Okay, here's the solution. How'd you do? You can see that because all of this property is either 5 or 7 year, there are only 2 factors in use. You can also see that the total depreciation expense actually went up as a result of not buying the new equipment. This shows the relative advantage of the half-year convention over the mid-quarter convention. Just so we understand what happens next, let's do depreciation for the copier in year 2. To make our lives easier, we'll assume that the new equipment is not placed in service in 2017, and thus the half-year convention is in use. We'll return to our table, find 5-year property for year 2, and the factor is 32%. The tables have the double declining method built in, so we do not apply the factor to the adjusted basis, but rather the original cost. $1,500 times 32% is $480. We can do the same thing for the computer, and the depreciation is $960. You can see from the previous example that once you start in a column, you march down that column for the remaining life of the asset. A couple of important points. Number 1, because of the conventions, it always takes a year more than the recovery period to actually fully depreciate for tax purposes. For example, a 5-year property always takes 6 years to fully depreciate. The tables take care of the double declining method, or whatever method is in play. Let's do a mathematical proof of the tables for those that really like this sort of thing. So we're going to start with a $1 asset, and it has a 5-year life. Using the double declining balance method, we would take that $1 divided by the 5-year life, multiply by 2, or 200%, and then take the half-year convention, and that would be 20%. Does that agree to the table for 5-year property in year 1? Yes, it does. So remember, year 2, now we're actually using the double declining method. So I'm down to 80 cents divided by 5 times 2, multiplied by a whole year, because there's no convention in the second year, we get all of it. That would be 32%. Does that agree to the table? Well, yes, it certainly does. In year 3, it's 48 cents we're down to, divided by 5 times 2, 19.2. Yeah, it agrees to the table, trust me. Year 4, we're down to 28.8 cents, divided by 5, times 200, times 1, 11.52%. Did you even check the previous ones to make sure they tied to the table? I bet you didn't. In year 5, we're down to 17.28 cents, divided by 5 times 2 times 1. That equals 6.912. Wait, if you haven't been checking, how would you know that this factor does not agree to the table? The maker system switches to straight line depreciation when it is more advantageous to do so. As a result, if you redo year 5 on the straight line method, which would be the declined balance of 17.28 cents divided by the year and a half left, you get 11.52. And guess what? That agrees to the table. Now let's turn our attention to real property depreciation. The use of the tables works the same, except that due to the relative cost, a mid-month convention applies to all real property. Depreciation basically works the same. So if Michelle places in service a new apartment building for $100,000, we go to, wait a second, this is a residential real property. We are in the wrong table. So let's bring in the right table. There we go. And off we go. So make a note. The factors that are in the right side of the table are still percentages. So 0.455 is 0.455% or 0.00455. So note that real property was not part of our earlier convention tests because no convention test is required. Real property is mid-month. In this example, although the taxpayer places in service more than 40% in the final quarter of the year, it is real property, not personal property, and therefore does not affect the convention test at all. So we have found that the tables build in whatever the convention is. That is, we do not take the first year factor from a half-year table and only use 1/2. We use the whole factor because it's already considered as 1/2. This works great because, well, there's only 1 year you can place property into service, and that's the first year. But you can take property out of service at any time. You could sell assets in the first, second, third, or any year of the property's life. When you do so, the tax rules require that the same convention applies going out as coming in. That is, if you used a half-year convention to start, you must also apply a half-year convention when disposed. Let's read this example. Okay, so we can track the depreciation life of this 7-year property through year 1, year 2, until year 3. But we sold the asset in 2017, which means we need to apply the same convention. The table doesn't know we sold in year 3, and it provides depreciation for the full year. Under the rules, we don't get a full year. We must apply the half-year convention, and thus we only get half a year. Here's another example, except the property was placed in service using the mid-quarter convention. So we depreciate this property the same way, except using the mid-quarter table. And everything goes smoothly until the year of disposal. Since we sold in the first quarter, do we switch to the Q1 table? The answer is a resounding no. We need to adjust the full year factor for a third quarter property, because once you start in a column, you stay in that column. If we take the property out in the first quarter, then we get 1/2 a quarter for the first quarter, and of course, none for the second, third, or fourth quarters, because we sold the property. Just to be clear, let's do a couple of quick examples on applying the mid-quarter convention to a disposal. In the first example, we repeat the last example. Third quarter asset disposed of in the first quarter. We get 1/2 of the first quarter of depreciation. We get none for the following quarters. If we had instead disposed of the asset in the second quarter, then we get a full quarter for the first quarter, 1/2 a quarter for the second quarter, and of course none for the third and fourth quarters, which is 1.5 divided by 4 quarters. And we can do this for each quarter if there's a disposal in that quarter. Wow, computationally challenging. Depreciation remains a bit of a lockstep process and sadly, way too complicated for something that could be so simple. We're going to learn in the next video how most of this is avoided, at least for the next few years. But this is the end of video T7C on cost recovery. Thanks for watching.